Welcome to the deep dive.
Yeah.
You're here because you want to understand how to build wealth effectively. And, well, maybe you've seen others or even yourself get a bit stuck along the way.
Uh-huh.
Today, we're going to try and give you a shortcut to understanding why so many investors stumble and how a different approach, value investing, might offer a potentially less risky path.
Exactly. We're diving into Seth Klarman's margin of safety, and this isn't just about, what to do right. It's also really about spotting and avoiding the common pitfalls.
Like learning where the thin ice is before you skate.
Precisely. Think of it that way.
Okay, so for you, our listener, who wants to cut through the noise, our mission today is pretty clear. Unpack those roadblocks and introduce value investing, a different way of thinking about the market.
Right.
Let's start with where most investors seem to go wrong. The first big one seems to be this confusion between speculation and actual investing.
Yes, absolutely crucial. And there's that classic story, about trading sardines.
Oh, right. Remind me how that goes again.
Well, the sardines vanish from Monterey. The price of canned ones skyrockets. Someone buys a load, finally opens a can, tastes it, awful.
Okay.
And the seller just says, "You don't understand. These aren't eating sardines, they're trading sardines."
That's brilliant. It perfectly captures it, doesn't it? Focusing only on the price, not the actual thing itself.
Exactly. It's a great reminder for listeners. Always think about the underlying value. Don't get stuck holding something just because its price went up. Speculation is really just betting on that price movement.
So it's driven by that greater fool theory, hoping someone else will pay you even more.
That's it. You're betting someone dumber or maybe just more optimistic will come along. And what's fascinating, often the actual business fundamentals, they just don't seem to matter much in those phases.
Prices get completely disconnected. Klarman mentions those Winchester disk drive companies in the early 80s.
Oh, yeah. A perfect example. Billions in market value, venture capital pouring in.
But the fundamentals weren't there.
Not even close. A Harvard study basically said the numbers couldn't justify those prices. Not then, not in the future. It was pure hype, classic trading sardines. And, predictably, it burst.
A good warning for listeners then. Question the hype, check the fundamentals.
Definitely. And it's not just tech bubbles. Even, seemingly safe markets can get speculative. Look at U.S. Treasury bonds.
Really, bonds?
Yeah, trillions traded daily. But the average time someone actually holds a long-term bond, sometimes just weeks.
Wow. So they're not holding for income.
Nope. They become trading vehicles, bets on tiny interest rate moves, trading sardines again, just in a different wrapper.
It's like everyone's just watching Mr. Market.
Right.
That emotional crowd.
Exactly. Speculators treat Mr. Market's irrational price swings as like some kind of wisdom. They buy when he's euphoric, sell when he's panicking.
Instead of thinking independently about the actual value.
Right. Klarman really stresses this. Mr. Market is just reflecting everyone else's mood swings, often irrational ones. So for our listeners, don't just follow the price.
And often, investors don't even know why the price is moving, do they?
That's another key point. Prices fluctuate for all sorts of reasons, some valid, related to the business, some completely random, like, fund flows or tax selling.
So perception can matter more than reality, at least short term.
In the short run, absolutely. Investor psychology can drive things way off track, which is why it's so critical for you, the listener, to look past the ticker symbol and focus on the real business underneath.
It's easy to get tempted by returns, though, especially when other options look dull. Klarman talks about reaching for yield.
Yeah, that happens a lot. Say bond yields are low, investors, hungry for income, pile into dividend stocks.
Seems logical on the surface.
But often those low bond yields are already reflected in higher stock prices. They're chasing yield often right near a market top. There's rarely a free lunch there.
Okay, so no easy wins, just chasing yield. What about simple rules like buying stocks with low PE ratios?
Ah, the low PE trap. It sounds smart, right?
Sure.
Buy cheap. But often, a low PE means the market expects earnings to fall. So you buy it, earnings drop like expected, and suddenly the PE isn't low anymore, even if the price hasn't moved.
Right. You have to understand why it's cheap.
Exactly. Dig deeper than just the surface numbers. Okay, so investors make their own mistakes. But Klarman also points a finger at Wall Street's influence.
Yeah, the incentives seem complicated.
Oh, very. Think about how Wall Street gets paid. It's heavily based on transactions fees for deals, commissions for trades.
So they make money when money moves.
Precisely. which creates this inherent conflict, doesn't it? Brokers might be incentivized to encourage more trading churning or push products with higher commissions, even if they aren't the absolute best fit for the client.
And underwriting new stocks or bonds, selling new issues.
Another conflict zone. The incentive might be to bring a deal to market, maybe even an overpriced or risky one, just to collect those fat upfront fees. The issuer, the company selling shares, becomes the primary client, maybe more so than the investor buying them.
So the listener needs to be aware of who's paying who, essentially.
Definitely. And it gets even more direct with merchant banking.
Where the Wall Street firms buy companies themselves.
Exactly. They start competing directly with their own clients, buying and selling businesses for their own profit. The lines get really blurry. It's hard to know whose interests are truly primary.
And this fee focus leads them to constantly create new things to sell.
Yes, that's a crucial point for listeners. By being both the investment bank creating the securities and the brokerage selling them, they can manufacture their own products, IPOs, new bond issues. These generate much larger fees than just trading existing stuff.
So there's a bias towards the new and maybe untested?
There can be. The closed-end mutual fund example Klarman uses is pretty stark.
How does that work?
Okay, so a closed-end fund might launch at, say, $10 a share. But maybe 8% of that goes immediately to underwriting fees, so only $9.20 actually gets invested.
So it starts underwater.
Often, yeah. The market price frequently drops below even that $9.20 initial net asset value pretty quickly. The first buyers can lose money right out of the gate.
Whereas a regular open-end no-load fund just trades at its actual asset value.
Right, a often simpler and cheaper option for many investors. And remember that boom in closed-end country funds in the late 80s, early 90s.
Vaguely, like funds for investing just in Spain or something.
Exactly. Huge speculative excitement pushed their prices way, way above the value of the stocks they actually held. Wall Street made a killing launching them, but many investors got burned when the hype faded.
It all seems to point towards a very short-term focus on Wall Street.
Absolutely. That upfront fee model really encourages looking towards the next deal, the next commission, sometimes without enough regard for long-term value.
Klarman mentions the equitization wave.
Yeah, early 1991, companies had loaded up on debt from takeovers in the 80s, often facilitated by Wall Street junk bonds.
Collecting fees then.
Right. Then when things got shaky, Wall Street helped them issue stock to pay down that debt.
Collecting fees again.
You got it. Fees on the way up with debt, fees on the way down with equity. It highlights that transaction orientation. Listeners need to remember this inherent short-term bias.
And there's also a natural tendency towards optimism, isn't there? A bullish bias.
Makes sense if you think about it. Wall Street generally does better when markets are rising. More underwriting deals, higher trading volumes, happier clients, inventory gains.
So maybe take those rosy forecasts with a pinch of salt.
A healthy pinch, yes. And even the financial innovations they come up with, they're not always designed primarily for the investor's benefit.
You mean things like complex derivatives?
Sometimes. Klarman talks about IOs and POs, interest-only and principal-only pieces of mortgage securities from the 80s. Very complex.
Hard to understand.
Very. And their long-term benefit for many investors was questionable at best. They carried hidden risks. The point for listeners is don't assume new and complex automatically means better for your portfolio. Often, it just means more fees for Wall Street.
Investment fads also seem to fuel this machine.
Oh, definitely. When an industry or a type of stock gets hot, Wall Street is right there, ready to launch IPOs, create new specialized funds.
Cashing in while the excitement lasts.
Exactly. Even if the underlying value proposition fades, they've already collected their fees. Listeners should be wary of chasing the hot dot.
So the takeaway is, be cautious with Wall Street. Understand their incentive.
Precisely. Be aware of the self-interest, the short-term focus. Go in with your eyes open, relying on them to always put your interests first. Well, that can be a recipe for disappointment. Do your own thinking.
Okay, besides individual mistakes and Wall Street's influence, Klarman also talks about the impact of institutional investors, the big players.
Yeah, this is huge. Since World War II, the market has shifted dramatically from individuals to institutions, pension funds, mutual funds, endowments. They dominate trading now.
And their sheer size changes things.
Massively. Their buying and selling decisions move markets. Understanding how they operate is crucial for any investor today.
And the money management business itself, how they get paid. Another potential conflict.
Often, yes. The typical model is getting paid a percentage of the assets they manage.
Not based on performance.
Sometimes performance fees are involved, but the base is often assets under management, AUM. This can create an incentive to just gather more assets, grow bigger, rather than maximizing returns for existing clients. Bigger isn't always better in investing.
And there's pressure for them to not fall behind their peers,
A
right?
huge pressure. It's called relative performance orientation. Nobody wants to be at the bottom of the league table. This can lead to groupthink or consensus investing.
Herd mentality.
Pretty much.
Yeah.
Managers might be hesitant to take a truly contrarian position, even if they think it's right, because if they're wrong alone, they could lose clients or even their job. It feels safer to be wrong with the crowd.
So institutional decisions aren't always about finding the absolute best value.
Not always. Career risk plays a big role. That bureaucratic structure in large institutions can also stifle truly innovative or unconventional ideas. Well, imagine proposing something really different. It has to go through committees, risk assessments. Personal careers are on the line if it goes wrong. It's often easier to just stick with the mainstream, even if it means holding on to overpriced stocks until everyone else starts selling.
Selling too early is seen as risky.
Can be, yeah. Holding on too long with the herd feels less dangerous individually, and the sheer scale causes problems too, diseconomies of scale.
Meaning it gets harder to get good returns as you get bigger.
Exactly. Think about it. There are only so many genuinely great investment ideas out there. A multi-billion-dollar fund might not be able to invest a meaningful amount in a small, undervalued company without moving the price too much.
So they end up focusing only on the biggest, most well-known companies.
Often, yes. They might completely ignore potentially attractive, smaller opportunities that could be perfect for an individual investor.
And many institutions feel they need to be fully invested all the time.
That ties back to the relative performance game. If you're holding cash and the market rips higher, you fall behind your benchmark and your peers. An absolute return investor, a true value investor, is happy to hold cash if there are no compelling bargains.
But institutions often don't have that luxury, psychologically or contractual.
Right, so listeners shouldn't feel they have to be fully invested if they don't see value. Cash is a position too.
This can also lead to weird categorization, can't it? Like a fund only buying certain things.
Yeah, overly rigid mandates. A junk bond fund might be prohibited from buying a distressed equity security, even if it offers a much better risk-reward profile than the junk bonds it is allowed to buy.
And what about window dressing?
Yeah, that's tidying up the portfolio just before the end of a quarter for the report, buying stocks that have done well recently, selling losers, just so the holdings look good.
Not necessarily economically sound decisions.
Usually not. It's about appearances. And then there were strategies like portfolio insurance.
That sounds sophisticated.
It sounded it, based on complex models using past volatility. But the idea was flawed, and it completely fell apart during the 1987 crash, actually making the crash worse. A key lesson for listeners: complexity doesn't equal safety.
Finally, Klarman touches on indexing. Just buying the market. It's become hugely popular.
Very popular, low cost, guaranteed market return.
It's appealing. And it's based on the efficient market hypothesis, the idea that you can't consistently beat the market because prices already reflect all known information.
But Klarman sees downsides.
He does. One concern is if everyone indexes who's doing the actual research to figure out what companies are worth, markets might become less efficient.
Interesting point.
Also, index funds are forced buyers or sellers. If a stock is added to or removed from an index, or if lots of money flows into or out of the index fund, they have to trade, regardless of price. This can distort prices, especially for less liquid stocks.
So the popularity of indexing, especially during bull runs when many active managers lag, doesn't mean it's without potential issues. Exactly. It's worth considering the potential unintended consequences. Okay, let's shift gears to a really dramatic example Klarman covers: junk bonds.
Right, the 1980s.
Yeah.
That market just exploded, didn't it?
Exploded is right. It was unique in its speed, its size, its influence, and even how popular it remained for a while, despite big losses later.
And it actually pushed up company prices generally.
It did, because suddenly there was this huge pool of money available for leveraged buyouts and takeovers. Traditional lending standards kind of went out the window. Valuations got stretched.
It started as just Wall Street generating fees.
That was the initial driver, yeah. But it kind of morphed into this almost a moral crusade. The narrative became that junk bonds offered high returns with surprisingly low risk.
Michael Milken was central to that narrative.
He was the key promoter, arguing that historical default rates were low and that these bonds were vital for funding innovative, smaller companies and restructuring corporate America.
But the arguments had holes.
Big ones. The idea that loading up small, growing companies with massive debt was the path to economic salvation was questionable, and relying solely on past default rates was misleading. The market was new, hadn't seen a real recession yet, and the quality of bonds being issued was declining.
And the early success kind of fed on itself.
It did, a self-fulfilling prophecy for a while. More money poured in, allowing buyers to pay ever higher prices for companies. As long as the economy grew and asset values rose, even weak deals could sort of muddle through, reinforcing the low default risk myth.
There was also that greater fool element again, especially with the riskier bonds.
Definitely. Particularly with things like PK securities, payment in kind, where they paid interest with more debt. The rationale often wasn't based on the company's ability to pay, but on the hope that someone else would refinance them or buy the bonds later at a higher price.
Risky bet.
Very. And a key part of the justification, the metric they used, was EBITDA, wasn't it?
Earnings before interest, taxes, depreciation, and amortization. Sounds comprehensive.
It sounds it, but it crucially ignores capital expenditures, the money a company must spend just to maintain its assets and stay in business, let alone grow.
So it overstated the cash available to pay debt.
Massively, in many cases. The implicit, often unstated assumption was that CapEx wasn't really necessary or could always be funded externally somehow. It was a fundamentally flawed way to assess debt capacity for many businesses.
And buyers and sellers,
Yeah.
they just went along with it.
Largely, yeah. Driven by fees, by greed, by the herd mentality. They accepted the flawed default claims, they embraced EBITDA, they bought into the diversification myth, the idea that a portfolio of risky bonds was somehow safe.
Until it wasn't. The market collapsed in 1990.
Pretty dramatically. Suddenly, liquidity dried up. They called them roach motels, easy to get into, impossible to get out of. The optimistic story flipped completely. Everyone suddenly focused on downside risk, and prices just plummeted.
Okay, so we've seen plenty of ways investors can go wrong. Let's pivot to the alternative Klarman champions. Value investing, built around this idea of a margin of safety.
Right. At its core, value investing is pretty straightforward, conceptually. It's about buying securities, stocks, bonds, whatever, for significantly less than your careful estimate of their underlying worth.
The bargain hunt. Buying $1 for 50 cents, as the saying goes.
Exactly that. It's finding those discrepancies. But it's not just about finding cheap stuff.
No.
No, it requires two things working together. First, a conservative, rigorous analysis of that underlying value. And second, the discipline and patience to only buy when the price offers that significant discount, that margin of safety, and then hold until the value is realized.
And these bargains aren't always easy to find, are they?
Definitely not. The number of truly great opportunities varies wildly over time. You need persistence, and you need to be willing to wait for the right pitch, as Klarman puts it, borrowing from baseball. Don't swing at everything.
And figuring out that underlying value isn't simple either.
Not at all. It's inherently imprecise. You can never know every fact, the future is uncertain, and even if you did know everything today, business values themselves are constantly changing.
Due to what? Economic cycles.
Yeah, things like the credit cycle, how easy or hard it is to borrow money that has a huge impact. Inflation, deflation trends, those change asset values too. Value investing can work in inflationary times, but you have to be extra careful not to overpay. In deflation, sometimes those hidden assets on the balance sheet become less valuable.
So it's crucial to understand why you think something is undervalued.
Absolutely critical. And that informs when you should sell, basically, when the reason you bought it no longer applies, either because the price reached fair value or because you realized your initial analysis was wrong.
And value investors also look for things like catalysts. Good management.
Yes. A catalyst, some event that might force the market to recognize the value is helpful. Good management, especially management with their own skin in the game, owning stock alongside you, is a big plus. Sensible diversification, maybe hedging sometimes, these are all part of the toolkit.
What's an example of a catalyst?
Could be lots of things. Management deciding to sell the company or liquidate assets, change in control, a spin-off, a major share repurchase.
Yeah.
Something specific that helps unlock the value.
Klarman uses that Texaco example after the '87 crash. Again,
Yeah.
right? For value.
Yeah, it illustrates how value can appear in messy situations. The bonds were trading at a deep discount because Texaco was in bankruptcy after the Pennzoil lawsuit. Huge uncertainty.
But the potential payoff was high.
Exactly.
Yeah.
Even accounting for the significant bankruptcy risk, a careful analysis suggested the bonds were likely worth much more. The potential return compensated for the risk, offering a margin of safety despite the uncertainty.
So despite academic theories about efficient markets,
Klarman is firmly in the camp, and I agree that markets are not perfectly efficient. Human emotions, institutional constraints, short-term focus,
oh,
all these things constantly create mispricings. Opportunities will likely continue to exist.
Warren Buffett's Super Investors of Graham and Doddsville essay makes that point pretty powerfully too.
A classic. Real-world evidence beats elegant theory sometimes. And there are forces that eventually help push prices towards value.
Like what?
Company actions, for one. Management might see the stock is cheap and buy back shares or sell off an underperforming division or take the company private, and external forces too, like takeover bids from other companies or activist investors pushing for change.
So value investing is kind of like arbitrage, but not risk-free.
That's a good way to think about it. Large-scale arbitrage between current price and estimated long-term value. But yeah, definitely not risk-free like classic arbitrage because your value estimate could be wrong, or it could take a very long time for the gap to close.
It's important to distinguish real value investing from imposters.
Yes, value pretenders, as Klarman calls them. The term value became fashionable, so lots of managers slapped the label on, even if they weren't really following the core principles of deep analysis and margin of safety. Some might even shift strategies just to attract assets. Caveat emptor.
Klarman also draws a line between top-down and bottom-up investing.
Right. Top-down is trying to predict the whole economy, interest rates, which sectors will do well, making big macro bets.
Which is really hard.
Incredibly hard to do consistently, and it generally doesn't offer a margin of safety. Bottom-up value investing ignores the big picture forecast, mostly. It focuses on analyzing individual securities one by one, looking for bargains irrespective of the overall market outlook.
Simpler, in a way.
Conceptually simpler, yes. Find a bargain, buy it, wait. It requires the skills of valuation and the temperament of patience.
And this ties into having an absolute performance goal, not relative.
Exactly. Focus on achieving your goals, generating good absolute returns over time, rather than just trying to beat an index or your neighbor. You can't eat relative performance, as the saying goes.
How does a value investor think about risk differently? Not just beta.
Definitely not just beta. Beta just measures past price volatility relative to the market. It tells you nothing about the underlying business, the price you paid, or future prospects.
So what is risk then?
Risk is the probability and the potential magnitude of permanent loss of capital based on fundamental analysis. It's about asking, what could go wrong and how much could I lose if it does? A stock can be volatile, high beta, but not risky if bought very cheap, and a stable stock, low beta, can be very risky if bought at an inflated price.
So short-term price swings aren't necessarily risk.
Not to a long-term value investor who bought with a margin of safety. In fact, short-term drops in a good company you bought cheap can actually increase your long-term return if you have the conviction and cash to buy more. Volatility can be your friend.
But you still need liquidity sometimes.
True, unexpected needs arise, and there's opportunity costs.
Meaning if all your money is tied up, you miss new opportunities.
Exactly. If you're fully invested in things that are falling or hard to sell and a fantastic bargain appears, you can't act. So having some cash or owning things that generate cash or have clear catalysts is important.
And the final reminder on valuation itself.
It's an art as much as a science. Business value is intrinsically imprecise and always changing. Aiming for pinpoint accuracy is often a fool's errand. Focus on being approximately right rather than precisely wrong. Continuous reassessment is key.
Okay, so if valuation is key, how do value investors actually do it? What methods does Klarman suggest?
He highlights three main approaches. Recognizing that none is perfect, but using them together can give you a good picture. First is net present value, or NPV.
Discounting future cash flows back to today.
Exactly. Estimate the cash the business will generate over its life, then discount those future flows back using an appropriate interest rate to find today's value. The tricky parts are forecasting those cash flows accurately and choosing the right discount rate.
Gotta be conservative there, I imagine.
Very. Your discount rate should reflect the riskiness of those cash flow estimates. And be aware that changing interest rates in the broader economy will affect your discount rate and thus the calculated value.
Okay, what's the second method? Private market value.
Yeah, this looks at what similar entire businesses have recently been bought or sold for, often in private transactions. You look at the multiples like price to earnings or price to cash flow paid in those deals and apply them to your company.
Sounds useful, but are companies really comparable?
That's the main weakness. No two companies are identical. Plus, The multiples paid in deals change depending on market conditions, financing availability, and sometimes the buyers in those deals weren't being rational themselves. Sophisticated buyers usually rely more on NTV analysis anyway.
Right. So use with caution. The third method, liquidation value.
This is generally the most conservative. It asks, what would the assets of the business fetch if we shut it down and sold everything off? It focuses primarily on tangible assets.
Like a worst-case scenario value.
Often, yes. A variation is breakup value, where you estimate what each individual division or asset might be worth if sold separately to the highest bidder, which could be more than a fire sale liquidation.
How do you estimate what assets are worth in liquidation?
It varies hugely by asset type. Cash is cash, obviously. Marketable securities are usually worth their market price. Receivables might only fetch a percentage of face value, depending on quality. Inventory is tricky, obviously. Finished goods might be worth more than raw materials. Real estate depends on the market. It requires judgment.
Klarman also mentions net working capital.
Yes, a super conservative shortcut popularized by Benjamin Graham. You take current assets, cash, receivables, inventory, and subtract all liabilities, both short-term and long-term.
So you're ignoring all the fixed assets like plant and equipment.
Exactly. If you can buy the stock for less than this net figure, you're theoretically getting the operating assets, brand, everything else, for free, plus a margin of safety based just on the liquidation value of the current assets alone.
Seems like a great deal, but are there catches?
Definitely. The main one is if the business is losing money, those ongoing losses will eat away at that working capital value over time. You also need to be sure there aren't significant off-balance sheet liabilities, but it provides a strong downside buffer.
And liquidation itself, while maybe sad for the business, can be good for investors.
It can be a powerful catalyst for realizing value if the assets are worth more sold off than the company is valued at as an ongoing concern.
Klarman uses ESCO Electronics, the Emerson Electric spinoff, to illustrate these methods, right?
Yeah, it's a great case study. He looked at NPV, adjusting for things like goodwill amortization, compared it to multiples paid for similar defense electronics companies like Hazeltine, estimated a liquidation value, and compared it to its peers in the stock market.
And all methods pointed to it being cheap.
Significantly undervalued, yes. Especially the gap between its market price and its tangible book value per share was quite striking. And the stock price did rise substantially afterwards.
This highlights that reported earnings aren't the whole story.
Not by a long shot. Earnings can be managed by accounting choices, affected by non-recurring items, or distorted by GAAP rules like goodwill amortization. The numbers are a starting point for understanding the business reality, not the end point.
Same goes for book value, just the historical accounting value.
Exactly. Book value might bear little relation to current economic value. Assets might be obsolete. Depreciation policies might be unrealistic. Write-offs or recapitalizations can distort it. It's often not a reliable indicator of true worth on its own.
And dividend yield alone is dangerous too.
Very. A high yield might just mean the stock price has fallen because the company's in trouble. They might be struggling to maintain that dividend, and it could be cut soon. Don't buy just for the yield without understanding the underlying business health.
So valuation is complex, requires judgment, looking beyond the headlines.
That's the essence. Focus on businesses you can understand. Be conservative in your estimates. Look for a significant margin of safety and accept that it's inherently imprecise.
Okay, valuation is one thing, but finding these potential opportunities seems like the first big hurdle. How does Klarman suggest going about investment research?
Well, the goal isn't just to process information. It's to find mispriced securities, so you're filtering constantly.
Where do you look?
He suggests several areas. Things like stocks hitting new lows or on the biggest percentage decline lists in the Wall Street Journal. Not that they're automatically buys, but they might warrant investigation. Companies cutting or eliminating their dividends. Reading annual and quarterly reports thoroughly is fundamental.
Any other areas?
Sometimes specific niches become attractive, like those thrift conversions we mentioned earlier. In such cases, it might pay to analyze all the companies in that category. Look for complexity that might scare others away.
And market inefficiencies or institutional behavior can create openings.
Definitely. Institutions might be forced sellers during mergers or spin-offs, creating temporary price pressure. Or they might be unwilling or unable to buy very small, obscure, or low-priced stocks, leaving opportunities for individuals. Thinly traded companies can sometimes get ignored and become cheap.
How do you know when you've done enough research? It feels like you could go on forever.
Klarman acknowledges this. The 80/20 rule often applies. You get maybe 80% of the crucial information with the first 20% of the effort. There's a point of diminishing returns. You have to accept you'll never know everything and make a decision based on sufficient but incomplete information protected by your margin of safety.
Watching what insiders, like management, are doing with their own money is useful too.
Very useful. Significant insider buying can be a strong positive signal. Conversely, if management is cashing out lots of stock options while telling the public things are great, that's a red flag. Their incentives matter.
So successful investing requires this continuous research effort.
Absolutely. It's not a passive activity if you're doing it yourself. You need to be constantly looking, analyzing, and reassessing.
Okay, so where specifically do these opportunities often hide? Klarman mentioned simple, undervalued growth companies are rare.
Yeah, the low-hanging fruit gets picked quickly. More often, value investors find opportunities where there's hidden value the market doesn't see, or in complex situations others avoid. And as we discussed, catalysts are often important.
Events that help unlock the value.
Right. They can shorten the holding period and reduce risk by providing a clearer path for the price to approach the underlying value.
He mentions rights offerings as one area.
Yes. When a company gives existing shareholders the right to buy more shares, often at a discount, if many shareholders don't exercise their rights, those who do, or outsiders who buy the rights, can sometimes pick up shares very cheaply. The Consolidated Oil and Gas example for its subsidiary IPO illustrates this.
And risk arbitrage investing in takeovers and stuff.
It's a specialized field, definitely not risk-free. Risk is in the name.
Hmm?
You're betting on an announced deal actually closing. Big players have informational advantages, but Klarman notes opportunities can arise, especially in large, friendly deals or during times of market panic.
Like that Bacor Western example during the '87 crash.
Exactly. The deal price was fixed, mostly in cash, but Becor's stock fell way below that value due to general market fear. The risk seemed low relative to the potential return for those who understood the deal terms. Risk-Arb remains attractive partly because it's complex and doesn't fit neatly into institutional relative performance boxes.
Spin-offs seem like a consistently fruitful area, he highlights.
They often are. Parent companies spin off units for lots of reasons: strategic focus, getting rid of a poor performer, hoping the separated parts will be valued more highly.
And the new stock often gets dumped initially.
Frequently, yes. Shareholders of the parent might not want the small spin-off stock, or institutions might find it too small or outside their mandate. Index funds might have to sell it if it's not in their index. This selling pressure can create bargains right after the spinoff.
Like the Intertan spinoff from Chandy.
Perfect example. The value in its Canadian and Australian stores was hidden by losses in Europe. After the spinoff, the stock initially traded below even its net working capital value, a clear bargain for those who dug into the details.
Thrift conversion, savings and loans going public, another key area.
Historically, yes, since the early 80s. These institutions often convert from mutual depositor-owned to stock ownership, and the IPOs are frequently priced very attractively, sometimes below book value, partly due to negative sentiment surrounding the industry at times.
The JSB Bancorp example.
Right. A solid little bank IPO'd at a low price to book and PE multiple, despite having minimal credit risk and high capital levels. Klarman also noted how a future stock repurchase by JSB could significantly boost shareholder value, another potential catalyst.
Finally, he talks about investing in financially distressed and bankrupt companies. Sounds scary.
It is to most investors, which is precisely why opportunities exist there for knowledgeable, patient analysts. Unlike newly issued junk bonds, these are securities of troubled companies trading below face value, often significantly so.
Why do companies get distressed?
Usually operating problems, legal issues like big lawsuits, or simply too much debt from past decisions. They face cash shortfalls, difficulty refinancing, nervous suppliers, fleeing customers, and employees. It's tough. But many continue operating under bankruptcy protection.
And the bankruptcy process itself can unlock value.
It can. It forces a restructuring of the balance sheet. Debt gets converted to equity, assets might be sold. It provides a framework and timeline, often 2-3 years, for resolving the problems and realizing value for creditors, who often end up owning the reorganized company.
How do you even value a company in bankruptcy?
You use standard methods like NPV or comparable companies, but you have to adjust for distortions caused by Chapter 11 things like interest income on cash balances, stopped interest payments on pre-bankruptcy debt, temporary bankruptcy professional costs, etc. You also need to carefully analyze the liability side, who gets what in the reorganization.
Starting with the most senior debt.
Right. Secured debt first, then unsecured. down to subordinated debt, and finally equity, which is often wiped out. Opportunities can exist at various levels of the debt structure, depending on your risk tolerance. The fulcrum security is the one most likely to be converted into the new equity, often the senior unsecured debt.
The HBJ Harcourt Brace Jovanovich example fits here.
Yes, in 1990, market perception was that it was way too indebted after fighting off a takeover. Its stock plummeted, but Klarman saw value in its subordinated bonds, which were trading at a huge discount even to a conservative estimate of their recovery value in a potential bankruptcy. Ironically, bankruptcy could even help those bonds by stopping cash interest payments to more senior unsecured debt holders.
So really digging into complex, unpopular areas can uncover real value.
That's a key message. Diligent research and insightful analysis are required, but the rewards can be substantial in these less crowded corners of the market.
Okay, so you found some ideas, done the valuation. What about actually managing the portfolio and trading?
Right, these are crucial too. How you trade can definitely impact your results, buying patiently, selling effectively. And portfolio management involves diversification, maybe hedging, and managing your cash and liquidity.
How important is liquidity? Being able to sell quickly.
For a long-term value investor, it's maybe less critical than for a trader, but you can't ignore it. Unexpected needs pop up. And market liquidity itself isn't constant. It tends to dry up precisely when you need it most, during panics. So a portfolio should have a balance, with higher potential returns justifying less liquid holdings.
And diversification. Don't put all your eggs in one basket.
Yes, but Klarman warns against over-diversification, what Buffett calls a Noah's Ark approach, buying two of everything. Knowing a lot about a few investments you understand well is often better than knowing very little about many.
So diversification isn't a magic bullet if the underlying investments are bad.
Absolutely not. A diversified portfolio of overpriced junk bonds is still a portfolio of junk. True diversification is about owning assets whose underlying risks are different, that won't all necessarily move together.
And trading itself. It's about exploiting others' mistakes.
In a sense, yes. The best opportunities to buy low often come when others are panicking or forced to sell unwisely. The best opportunities to sell high come when others are overly exuberant. Trading is the mechanism for capitalizing on these temporary mispricings identified through your research.
What about options for individuals who don't want to do all this research themselves? Mutual funds.
Theoretically, mutual funds look attractive: professional management, diversification, liquidity, low-cost entry. But Klarman notes their actual performance track record is, on average, pretty mediocre.
Load versus no load funds.
Definitely prefer no-load funds without an upfront sales charge or commission. Why pay extra when good no-load options exist?
And open-end versus closed-end.
Open-end funds issue and redeem shares continuously at their net asset value, NAV, so liquidity is usually good. Closed-end funds have a fixed number of shares that trade on an exchange, so their price can swing above or below NAV. Generally, open-end funds are more straightforward, though sometimes you can buy closed-end funds at a significant discount to their NAV, which can be attractive. Just avoid buying them at the IPO premium.
Ultimately, choosing any advisor or fund manager comes down to trust, doesn't it?
It really does. Klarman stresses this. You need to understand their investment approach, believe it's sound, and trust their integrity that they will act in your best interest, not just their own.
How do you assess that?
Personal interviews if possible. Ask tough questions. Assess their ethics. Do they eat their own cooking? Invest their own money alongside clients. Klarman points out how few junk bond managers personally invested heavily in junk bonds. That's telling.
And evaluating past performance.
Look beyond just the headline number. How long is the track record? Did they perform well in different market environments, up and down? Was it the same manager throughout? Were returns consistent or lumpy? How did they make money? Was it skill or luck? And is that strategy still viable today?
And even after hiring someone, you need to keep watching.
Absolutely. Monitor their behavior, their results, whether they're sticking to their stated philosophy. It's your money, after all.
So wrapping up this deep dive into margin of safety, what are the absolute key takeaways for our listeners?
I think it boils down to this. Many investors get tripped up by chasing prices instead of value speculation, by Wall Street's inherent conflicts and short-term focus, by following the institutional herd, and by buying into flawed narratives like the junk bond craze.
And the alternative?
Value investing, grounded in that concept of a margin of safety, buying with a buffer, because you know valuation is imprecise. It requires rigorous analysis, discipline, patience, and focusing on absolute returns and risk defined as potential permanent loss.
You, our listener, came here wanting to cut through the noise and gain knowledge quickly. We hope laying out Klarman's framework has provided a solid foundation for thinking critically about investing.
Yeah, and maybe a final thought to leave you with. In a market that's so often driven by fear, greed, and short-term noise, cultivating that rational, patient, long-term, value-oriented mindset, that itself might be the single biggest, most sustainable edge you can have.
Something to definitely consider. How can you apply these ideas yourself and maybe dig even deeper into value investing in challenging market narratives? Lots to think about.